Good morning,
Okay.
ladies and gentlemen. Welcome to the first webinar in our new webinar series here at Zamara. We plan to host these regularly through the corona pandemic and possibly beyond that as well. In fact, our next webinar, which will be announced shortly, is scheduled for Wednesday, May 6th. That's next Wednesday. So we look forward to having you there too. I'm delighted to see that we already have over 130 attendees on the call. And no excuses for traffic and other delays. So we'll be starting these very punctually when we host them, which is also very exciting for me. I'd also request that you please bear with us. This is new technology for us. This is our first go at this. So there may be some growing pains, and we ask that you kindly bear with us. In terms of Q&A, some housekeeping issues, you will find that as an attendee, you have a few buttons at the bottom of your screen. There's one for Q&A. So if you have questions, you can post your questions to the Q&A. If it's a specific speaker that you're addressing your question to, please state the same in the question. I will be keeping an eye on the question and answer panel, and we'll be trying to respond to as many of your questions as we can. In terms of audio, you should all be able to hear us. You will not be able to speak. That's just a function of the webinar setup, given the number of people involved. But you can type on the chat, and you can type in the question and answer panel. If you have any technical issues, please post them on the chat, and we will see how to help you. So without further ado, I think we can get into it. Today we have three great speakers. The topic for today's webinar is Impact of Corona on Pensions. Our first speaker for today is, I'm sure most of you on the call know Nicholas very well. He is a veteran in the industry. He is the CEO of Co-op Investment Trust Services in Kenya. He's been a fund manager specifically for pension schemes like ourselves for over 15 years. And yet somehow he's still in the top 40 under 40. And some of these things don't make sense because he's worked 15 years, but he's top 40 under 40. And he also has 4 children. I'm not sure how he had 4 children so quickly, but he seems to have managed. He's very proud of his kids. Nicholas, welcome. I hope you can share your screen. I hope you don't have the same problem with Kwame, and we look forward to hearing your presentation. Thank you.
Okay. Thank you, Adil, for that kind introduction. I'm happy to be here, especially given the circumstances. I hope you can hear me, Adil.
Hearing you loud and clear. Thank you.
Fantastic. So I'll thank you all, and happy to be here, and hope everyone is safe. So I'll just jump straight through to my presentation. I'll try and share what I have a couple of slides I had prepared just to enable us follow through the discussion. I don't know. Is that working for you? Can you see it?
Yeah, we can see that. I think you just need to turn it into presentation mode, and we're good to go.
Perfect. All right. So I think is mainly trustees. Trustees, we are given the circumstances. I think my work here was just to talk about the impact of COVID-19 on pension fund investments, and I had given Kwame he had taken rather the assignment of doing economic data, which I'm sure you'll still be able to present. So I'll just focus my area mainly on how the markets are reacting, and then I'll talk about performance, especially for trustees. I'm sure they're very keen to understand how is the performance looking like in Q1. You've not received the reports, and more importantly, how is the 2020 going to pan out given what we see in the coming number of quarters. Unfortunately, I had to start with COVID-19 slide, and please get used to seeing this slide for a couple of quarters now, and probably even into next year. It will be largely explaining most of the demographics, the investment numbers, what we'll be talking about, and the numbers quite there. I mean, I'm sure people are following through on their local TVs or international TVs and social media. And largely put, there's been a significant number of good data which has come through in the last 1 month. Within, when it was pronounced as a pandemic, which was March 11, 2020, people are very unclear what we're dealing with. And most of the economies and most of the states moved into what you'd call shock and not excessive, but large stimulus packages to support what people didn't anticipate. But as time moves on, it's becoming clear. Unfortunately, we are seeing very high numbers of death in terms of count. But when you put it in context, when you look at other diseases we've gone through, you realize that it is not even as close to some of the things we deal with. we are dealing with almost levels of 0.05% death rates. So the infection rates are alarming, but the death rates are a bit, supportive in terms of just returning back to normal. So again, across the globe, you'll see high infection rates for coronavirus. Again, is a factor of how fast most states can test. People are really tracking the US because they're quite able to test their systems fairly fast. And of course, what followed through is a sharp shock is quite evident in the U.S. employment claims, which has jumped to unprecedented numbers for what we've seen. So locally here as well, in the Kenyan markets and the Kenyan economy, I'll try to be very politically correct. You see, the state did move fairly fast, in my opinion, which I feel was warranted, and has been able to stem a bit of flow of the cases. If you look at the progression compared to similar states within Africa and also especially Europe, then we are doing way much better than them in terms of the flow of infection. But that said, I'll jump to my area. I was talking about the health and what we are seeing on a daily basis, and I'll simply jump through to what is happening in markets, and I will talk about interest rates for a few minutes. Then I'll move to equity markets, and then I'll do a bit of time on Q1 performance numbers just to give you the general overview of what is happening, and then I'll talk about the expectations of 2020, which I'm sure most people are keen to hear. So locally here, in terms of interest rates, we've seen various players and regulators come and move fairly fast in terms of providing support. We have seen CBK drop the CBR even as good as last night. They dropped it back to, dropped it again 7%. They've dropped the CRR ratio, which has a direct impact. That was just releasing another 35 billion, which is available from the banks to release to the economy. So in terms of rates, we have seen support from CBK. In terms of the markets, of course, it's been met with mixed reactions. There's a large anticipation of almost a flattish interest rate outlook, mainly because we expect the government to have strains in terms of what they were meant to do with regards to their budget. Of course, there's a realignment of where they're spending their money. Then on the backdrop of that, there is inflows of funds from the investors, ourselves, the banks, who prudently would probably slow down in terms of lending, and that money will go back to the government in terms of treasury bill issues or treasury bond markets. So that simply put, the interest rate environment is, for lack of a better word, is one of the few sectors which will give us a positive return in 2020, which if things proceed as they are, and of course all factors remaining constant, as much as that means, I don't know what that means anymore in terms of remaining constant, but you understand what I mean in terms of the treasury bills and treasury rates in terms of the parameters we in place. I think we are happy to see how fast CBK is coming in. They've issued an infrastructure bond last month, which is closing this month, sorry, in the month of April. Raised about 38 billion. They are now a 5-year bond anticipated in the month of May. So they're quite aggressive about picking up money and, of course, moving fairly fast to support what they're calling COVID-19 pandemic. In terms of bond yields, trustees, you'll see, as I said earlier on, you'll see long-term bonds. Again, people are moving away from giving the government long-term money. Mainly because of how, as you move on and it becomes unclear, people want to remain as short as much as possible. And you'll see the 0 to 5 year on the tenor, you'll see a lot of participation there, mainly from the banks and also from investors like ourselves and pensions and insurance companies. So the short term has slightly gone up. Long term and medium term tenors, anything above a 10-year bond, has largely dropped by marginal, which means it's a positive. Report so far. I think for Q1, which I'll talk about later on, you'll see the bonds were still able to give us about 2.5% to 3% return in that quarter, which remains a positive, one of the positive segments we're talking about in 2020. So on equity markets, which is the biggest monkey in the room, as again you can see the stock markets took a beating, especially in month of just end of February and month of March, and we had significant drops. For the quarter in particular, we saw the NSE 20 share index at levels of negative 26%. The NASDAQ was about 20% drop. But what I'm mainly proud to talk about today is a recovery when you look at the lowest point of the curve, and you've seen some good recoveries. uh, especially in terms of particular stocks. And you've seen, on the market in totality, since we closed the quarter, is about 3% up. And of course, largely most of it is Safaricom and a few banks which are taking a serious beating when things happen. But as we move on, and this is what I probably want to tell all the attendees, is that we are probably dealing with the biggest drop in Q1 as compared to the upcoming 3 quarters, which again will also paint or paint the picture we're talking about. Let's talk about the expectations of 2020. So you will see in the slide there, if I jump to offshore markets, which you'll appreciate, this is where the impact was really felt. You'll see the bars in yellow talk about year-to-date numbers. You see, for example, MSCI World Index has done negative 33%. But when you compare that with the lowest point and now, you see is a negative 14%, which means there's been some recovery. Okay, again for us, which means that as much as you're seeing the global stimulus packages come into place, again, you remember these stimulus packages come mainly because the governments are very keen to make for two things, mainly the extent of what we'll go through in terms of the pandemic and the shocks that we'll go through, to either make them a bit softer and of course shorten the period. So you'll see the mini stimulus packages in terms of government initiatives. You will see will help the markets recover fairly fast. Again, for markets, we normally are about 8 to 9 months historically ahead of the data. That means we don't wait to see the actual numbers. So once there is that change of sentiment and there's, as we move on, you'd appreciate right now we have clearer information, compared to where we were a month ago, which is now giving the investors that confidence to probably jump into markets and take some aggressive positions, albeit with a bit of issues here and there. It tells you that people are actually returning back to normal. People are taking a few positions aggressively, and they expect the whole thing to probably unwind as we move on. So in terms of portfolio performance, I think just to jump through to what I think I focused on for this conference is to talk about what we've gone through, and especially for the Kenyan market. Most of you are very keen to see what has happened in Q1, and of course try and understand what will happen in 2020. So what I've put up there is just to show you, as per the ZCAS survey end of 2019, is what largely most pension schemes are holding in terms of asset allocation. And you'll see there on the fixed income tab, you'll see on the top of the graph there on the black background, you'll see about 65% was in fixed income, about 24% was in equity markets, and less than 1% was in offshore. And then you'll also see another asset class, about 9% on a global scale was in property. And the average return there was about 17.7%. And again, the backdrop of that was a very strong performance by the equity markets of close to about 34% on most of the schemes. But fast forward to Q1 2020, again, which is what we are here to talk about. This is probably, if you've not seen your report from the respective fund managers, this is what it is looking like in terms of indices. So what I've put in there is the indices that we track, just to give you an indication of performance. And MSCI World Index dropped by a negative 21.4%. Again, just an indication of what is the reaction that the markets have had to the pandemic. We also have our local indices there. We have Zamara Equity Index, about 15 stocks in there, about negative 27.5%. We also have the NASI, which again largely has Safaricom, against an all-weighted index, negative 21.21%. Fixed income, again, why fixed income is in asterisks, because I've used a combination of the bond yields and what you're earning on T-bills and and fixed deposits. And give and take, we had about 2.9% or 3% return in that quarter. So when you combine all those, given the asset classes we talked about the close of December, we expect to see about negative 3.2% in the quarter. And again, the range is quite wide, but all indications point to a -2 on the bare minimum to a -5% on the schemes who are very aggressive on equity markets. And in that, you'll see that, of course, we're waiting for the ZCAS reports to come out, which will give us a better indication of where people performances lie. But what I would like to jump to is now to give you our projections for 2020. And again, these I've used the backdrop of Q1, which means we are more or less focusing 2020 in terms of the 3 quarters. Again, for the schemes, this June year end, we still expect a positive return. As at probably 9 months, which is the end of Q1, most of them are still able to post positive numbers, but within the ranges of single digits. So in MSCI World Index, we still maintain a negative 21.4%. And again, the assumption here is that we expect that index to remain flat, or at least on the bare minimum, not to go beyond the prices we saw in Q1. NASI as well, we are dealing with a negative 21%, going in the next couple of quarters. And given how the markets are reacting, I did show you the recovery on some of those stocks, especially in the last 1 month. You'll see that the accounts, the indices actually recovering, and some stocks have shot up fairly fast, almost close to about 10%, if you look at the lowest point within the quarter, Q1. So in fixed income, again, we've used 2 scenarios. We expect a fairly stable interest rates. Of course, we'll go through the motions of stimulus support, and of course, what we'll expect to see as government adjusting their budget, and of course, the government borrowing and the targets which will be revised. And we've used an expected return of about 12% if there's no volatility on interest rates. If there is some volatility on interest rates, which means a 10%, which means you expect about 2% negative on capital movements, you'll achieve those two. You'll achieve a performance for the entire scheme of about 2.7% if you assume a 12% focus on fixed income, and if you assume a 10% return on fixed income of 1, to give you a 1.4% on the overall return. So largely put, trustees, is that we are really banking on fixed income to provide the support in terms of 2020. This is the year we say we're not looking for aggressive returns. We're looking for more of repositioning of our asset classes, and more importantly is preservation of capital, which again in a year like 2020 remains the key overriding objective. So Adil, I think I'll want to stop there, and I'm happy to take questions regards to that. I'm sure that will be done by the end of the session. So I think over back to you, Adil.
Great stuff, Nick. Thank you so much. I think that was really enlightening presentation. Thanks for sticking to your time as well. There are a few questions. You can have a look at them on the chat, on the Q&A panel, but we will answer them. We will answer them at the end, so you'll get a chance to come back on, and I'll throw the questions at you guys. So Kwame Owino, who is the CEO of the Institute of Economic Affairs. So Kwame has been instrumental in leading the Institute of Economic Affairs and transforming them into the go-to think tank for sub-Saharan Africa and the region. Having risen through the ranks at IEA, Kwame has led research and policy dialogue in economic regulation and competition policy. He also has diverse interests on economic regulation, employment economics, and public sector reform. He undertakes and oversees research in IEA's Kenya's key policy areas on public expenditure and revenue analysis, international trade, economic regulation, evolution, and the use of future methodologies to inform public affairs in Kenya. For those of you who were at our conference in Mombasa, you'll remember that Kwame was a presenter there as well, and left us with a lot of useful information. So I look forward to hearing what he has to say. He's going to talk about the economic impact so far, and also looking forward with respect to Corona. So Kwame, over to you. James, if you can just make sure that he can share his screen, and we look forward to hearing from you, Kwame. Thank you.
Okay. Thanks a lot, Adil, for the kind introduction. I hope everybody can hear me. So let me try and share my screen. I have a couple of
James, okay, perfect. Look, these guys are already on the ball. There you go, and they will jog the slide.
Okay, fine. So should we go to the next slide, please? So thanks a lot, and I'm sorry to the audience for this mishap. So the outline is, I'll just talk about what Kenya's growth prospects and what the state of the economy was based on some numbers right before the emergency came up. And then I'll talk about the trends in Kenya's economic growth and what the implications are, since there's a little information now, and it's possible to tell what its effects would be, how it affects economic projections across various sectors, employment, taxation, revenues, and then talk about its effects on national incomes as well. So next slide, please. Okay, so at the beginning of January, the World Economic Outlook, which we find fairly credible, published figures for what the expectations would be, projections, for 2020 and 2021, and with some numbers based on the fact that third quarter numbers were available. So this is what it said. The world was expected to grow at 2.9, 3.3 for this year, for the whole world, with 3.4. But the significant thing was that the East African community countries had actually twice as high, almost twice as high, growth rates that were anticipated were twice as high as global growth, of which Kenya's was even much higher. Now, the reason this figure is important is, remember, this is just in January, by mid-January. The problem about COVID was already apparent in China and some parts of Southeast Asia, but it wasn't clear how far it would go, and nobody knew that it was as contagious as it is. At the end of last month, these figures were revised quite aggressively. Obviously, world growth is actually expected to contract. Kenya's growth rates by the CBK were revised actually by half. So basically, the thinking was that Kenya would grow at about 3.3%. I still think that is ambitious because it holds a few factors constant. But on the whole, there's been a very, very sharp reduction. And overall, the World Economic Outlooks, or rather the Regional Economic Outlook by the IMF, published in June, or rather published last month, the end of last month, states that the expectation for Kenya over the next 12 months would just be 1% growth. And we'll try and speak about what the implications of that are. The Treasury is still very hopeful. I think the expectation is it'll be about 3.2 or 3.4. And of course, it all depends on the assumptions, but we think globally, and some of the global effects of COVID in its effects on global supply chains and the ability to actually bring in supplies to allow for sectors to work, its effects on tourism, on transportation, I think are much, in my view, would be much harsher than what we have thought so far. So even if the health side is okay, I still think that the expectations of 3.3% would require very, very hard work in the next 2 quarters for us to see that. But let's go ahead. Let's go to slide 4. Now, well, again, this is just basically tracing Kenya's growth path over the last 10 or, almost 15 years. And Kenya's growth as a GDP growth, one of the things that you see is the numbers are good. The problem seems to be inconsistency. And the reason I think this is essential is my thinking is that Kenya tends to have a good run. And when we have one shock, and the losses tend to be substantial. Some of those losses are related to politics, as you can tell in 2007 and 8, 2013. I think we had a mild one in 2018-19. But towards the end of 2018, 2019, it was very, very clear that while growth was taking place in Kenya, I think the stability of that growth and the strength of that growth and how it spread throughout sectors was something that was troubling. So those numbers looked strong, but on the whole, the underlying economy was not necessarily as strong. So basically, we had sectors that were losing people in terms of jobs. There was shrinkage. Manufacturing wasn't growing fast. And most critically, and I think the economic survey shows it, agriculture and subsistence agriculture as a share of gross domestic product was actually growing, which suggested to us that Kenya was experiencing a dangerous thing, which is basically premature deindustrialization. So industry and manufacturing as a share of GDP every year had shrunk in these same 15 years from about 14%, I think at the peak in 2004, and had come down to about half of that, 7.8, and this year it's expected to grow to about 8.1. So that has implications on the one side for employment styles, what kind of employment structure. It has implications as well for what the demography is. So that was one thing that's important to bear in mind. So while growth rates seemed impressive before this shock, I think the structural effects on the economy were such that Kenya's economy was getting, quote unquote, in historical terms, more primitive, while incomes were growing at some impressive rates, at least based on GDP alone. So let's go to number 5. Yes. Now, so this column is probably the most important thing that I would say today. So those, I think it's the most profound thing that you can say based on what we know now. Now, in 2019, GDP projections, GDP assessment for Kenya at the end was 9.74 trillion Kenya shillings, which is about $98 billion. The initial growth rate expected was 6.2%. taking that to 6.2%. So what I have here are scenarios. So the green is a best scenario based on expected projections by the World Economic Outlook. By Treasury at the beginning of the year. The World Economic Outlook was a little lower than that, but close to that as well. And then the final one is the one in red is the worst case, but it's based on, again, the assessments that came from the ministry, the Regional Economic Outlook at the end of March. So what you have there are assumptions of growth rates, each based on the best case, which was Autor's expectation. The second one is the shock and the revision. And the third one is basically what the worst case shows. Now, what do they mean? Now, the meaning under green for the third column, which is basically 2020 projected GDP. So the size of the GDP and the 2019 numbers would be our baseline. It means that Kenya's GDP was going to pass the 100 billion mark. So it was going to come to 10.34 trillion if the 6.2% growth rates were maintained. If the 6.2% growth rates were maintained, it was going to get to 9.96 and a 2.3% growth rates per annum. And obviously, it's basically going to move from 9.74 under the red line to 9.84. Now, what this shows you is if you place the gain would have been an additional 600 billion Kenya shillings in value added under that 6.2% growth rate. The additional one would be 224, and our 1.1 it would be basically just 98. Now, the reason these three figures on the last columns are important is because if you think about the fact that it's clear that Kenya is not going to get to 6.2 billion this year, 6.2% growth rate this year for GDP, it means that if we take the 2.3% as the midline, which is what many people think is realistic, there'd be additional lost value that is irrecoverable, value that has not been created based on the emergency of the epidemic and other converging factors of about $400 billion. 400 billion Kenya shillings, which is $4 billion. So that's like 4% of GDP growth. So those differences are material based on the shocks that will come here. If, however, it goes down to what the global regional economic forecast thinks, outlook thinks, which is just barely 1.01%, then it means that GDP growth rates would be, the additional GDP, addition would just be 98 billion for the economy, but that is lower in income per capita terms than it's lower in income per capita terms than what than population growth. So obviously what that would mean is that yes, you have marginal growth in the economy, but actually GDP per capita growth, incomes would actually be lower by virtue of the fact that the GDP growth rate is much higher than, much lower, is half of what population growth rates are. So in our understanding, that's a significant thing. This also has implications for what poverty levels would be, which I go to next. So let's have the next slide. 6, yes. So the changes in national income. So we've seen what the changes at the global macro level would be. Again, remember the baseline, we're making straight line linear assumptions, but that's okay for the short term because it's very clear if you have 1 year as a baseline. So again, the GDP per capita in 2019 in Kenya was 204,629 for the whole year. And at the 6.2% growth rates, we'd expect a GDP growth per capita of about 212, and a 2.3 comes to 204, and one it comes to 202. So as you can see, the red line, it tells you that with a growth rate of 1%, which is basically close to contraction, Kenya's income per capita would actually contract. So Kenyans would be actually poorer on account of the fact, on an average level, on account of the fact that GDP is growing at a much lower rate than income. GDP is growing at a much lower rate than population growth rates. So I think these are the assumptions, in my view, very reasonable assumptions that you can tell right now. And obviously, even at 2.3%, there'd be barely growth. So just a couple of hundred more shillings, there'd be substantial growth of about 8,000-9,000 shillings per person a year, and a 6.2% growth. Now, why is this important? I think this is important because one of the things it tells is what would be the effect, what the effects of a shock of this nature is. And let's remember that at the beginning of the year, while Kenya was expected to grow, the nominal GDP growth rates were high, were impressive rather. But there was already expectations of shocks coming from the locust infestation, which obviously is going to come to a second phase and possibly a third phase, and which will be much, much worse. And that's part of the reason why our estimate, or rather at the Institute of Economic Affairs, we don't make forecasts, we don't think they're scientific, but one of the things we tell contextual narratives around is to ask ourselves what would affect these assumptions. Our view is that one of the things that you see is the Treasury has admitted itself that because of the problems with global supply chains, so the spraying chemicals that were expected to come to the country by mid-April were delayed, and for that reason, locust control would actually be less aggressive than it would have been, which suggests that we might have a second and third cycle. And if there is a second and third cycle of locust growth, each generation is 20 times bigger than another, than its preceding generation, which might put us in much, much more trouble with food and obviously its effect on people's incomes generally. As you can tell, I said earlier that Kenya has a kind of premature deindustrialization where agriculture is growing as a share of GDP from about 24% 10 years ago to right now. The last figures that were released by the Economic Survey a couple of days back suggest that it's actually 10 percentage points higher. And all this has been gained largely at the expense of industry and manufacturing. So let's go to the next one. Next slide. Yes, so now let's talk about the other effects that you can reason based on the contextual narrative that we have and some of the data that are here. I think there are public revenue implications. Now, the public revenue implications are clear. One of those is that people have not worked. Some people in major urban areas in the formal sector have not worked for 3 weeks. And employers have responded, in my view, in a way that is defensible by either chopping wages or in some cases, actually, what we call furlough, just keeping people assured of their jobs, but saying, look, as soon as work begins, then we'll be able to get back everybody and pay incomes. Now, what that does is obviously if people don't have, if incomes are lower, for whatever reason, if you say you have a 5% chop, then it means the revenue implications are hit on the other side. Right at the time when government needs these revenues and is relying on these revenues to be able to support, whether it's a stimulus program. I'll talk about that stimulus program and effectiveness later. The other is we have to ask ourselves what's the revenue elasticity in response to GDP growth, of course, which has fallen from about 6.2% at the expected level and is right now at about 3%. Sensible people say about 2.3%. Others, global figures suggest that the next round of COVID emergencies will actually be felt in the next quarter. It will be very tough and it might even be much, much bigger. If that happens, of course, this time, the ripple effects will also come back home and not in a good way. They'll be adverse. Obviously, for export performance as well, as you can tell, mostly commodity exports, horticulture, commodity exports such as horticulture, that definitely has been affected. Some tea, the auctions reasonably, but obviously if there are no ships and people's incomes are affected, then obviously consumption will also go down in export places. We can talk about the flowers with the reduction in transportation. Obviously, those exports will come down. We can't tell this early by how much, but it's severe. In the transport sector as well, obviously airlines aren't traveling except for some with cargo, which are also limited. That too comes in. And the other area basically is just the urban food costs. So the urban food costs, well, people are not working. At the same time, there was a rush. So some places, food costs went up. Not as much as people had expected, but at the same time, definitely there was some hoarding initially before it became clear that it wasn't going to be a full-blown crisis as everybody expected. So as I conclude, I think what I'd like to say is that a crisis such as COVID leaves Kenya vulnerable for two reasons. It shows that high growth rates alone are not enough. Or rather, let me say a growth rate of about 6% is not sufficient to cover a country from this. So that's one. It also confirms the connectedness globally. So if airlines can't travel, tourism is affected, exports in horticulture cannot happen. And then we have the other problem, which is basically, this is a health crisis primarily, or at least at the beginning it was a health crisis primarily, but we have to switch off the economy in terms of, as everybody says, taking the economy in a coma to ensure that the community spread does not take place so that there's a surge in infections to flatten the curve. All those are sensible. But what it suggests to us that a typical stimulus program, even assuming the government of Kenya had money for it, and there's no chance that you have sufficient money, but even assuming that you had, a typical stimulus program would not work. Part of the reason a typical stimulus program would not work is that a stimulus program works when there's idle capacity. This time it's not about capacity being idle, it's actually because you need to switch off that capacity in order to prevent spread. So we're in a situation where I hear many people say government should switch on a stimulus program. I think that there's a need to think a little bit more, because this is not a demand side shock. This is part of it is actually the bigger one, is a supply side shock, because you have to ask many people to stay away from work to ensure that that does not happen. I think for that reason, unless government has, and your typical monetary policy tools, which is reducing that, in my view, will not work. Why? So for instance, reducing, so for instance, if we talk about what government has done, which is basically to reduce income tax rates and which is completely appreciated. I think it's one of the biggest we've had in generations in Kenya, from 30 to 25. But if people are not working and there's no income, then obviously returns would be higher, and the escalatory effect in terms of the multiplier will be much, much smaller. Whatever people think, and I think many people think out there, the possibility of a lifeline for corporations that will be able to keep people so that we can start should have been considered. And some of the estimates that I saw from David D and others was a very modest 150 billion program. Should be very modest for a country like this. I think we're going to pay a very big price for the fact that part of it was cynicism, and to be honest, some of the analysis I've seen about what the real problem is here about the COVID thing is completely bad economics. Thank you very much.
Hi, Kwame. Thank you so much. That was a very enlightening presentation, if not a little bit scary. We'll be moving on to the next presenter, Angela. Before I do so, I just wanted to point out for Nick and Kwame, there are 9 questions currently on the Q&A that I've not yet responded to. The last question, actually it's now 10, I think. There are, I think, about 3 questions that, Kwame, you can take. The one about central bank growth rate, upward growth in the economy from Kilungu, and Anyango's question about agriculture. I think maybe you can take those. Not now, I just wanted you to prepare. We'll go through the questions at the end after Angela's presentation. The top half, I think there's about 5 questions at the top, Nick, that you can probably answer. So you can just have a look at those as we continue. Before we bring Angela on, I forgot to mention this earlier, apologies, but I wanted to let all the attendees know that we will be running 2 polls during the presentation. So over the next 20 minutes or so, there will be 2 polls that the IT team will post, and we'd love to get your responses to those questions. And also just a note that at the end of the presentation, you will also get a feedback survey so that we can get your input and improve as we go along. So next, our last but not least, our final speaker for today is Angela Okinda. Obviously, I would call her a big boss at Zamara and a legend in the industry. I'm sure all 350 attendees know Angela well. Angela heads up our umbrella solutions here in Kenya and is also playing a significant role developing our businesses in the rest of Africa. As I'm sure many of you know, Zamara has been expanding its footprint. We are now in over 5 countries across the continent, and Angela is playing a key role in developing our pension capabilities across Africa. Just like Nicholas, Angela was also in the top 40 under 40 for this year, so congratulations to Angela for that. Angela, over to you. We look forward to hearing from you. Thank you.
Okay, I hope you can see my slides.
Hi, Angela. Yeah, just confirming. I can see your slides. I'm sure everyone else can. Thank
All
you.
right, thank you. So I'll get started. Thank you for everyone who's logged on to the meeting. I think it's a great opportunity to connect, even though we can't meet physically. And my task over the next 15 minutes is to talk to you around guidance to trustees and members of retirement funds, particularly with respect to the impact of COVID-19 on pensions. I think Kwame and Nicholas have already set a fantastic pace, so my job is actually the easier one. So I'll put a little bit of perspective into the crisis, and then I'll just dive into the presentation and then take questions at the end. One of the things we need to keep in mind is that the pensions sector globally was already in some sort of crisis before coronavirus, right? And when you look at statistics, it shows that for all the 8 major markets, including China and India, which have the largest population across the world, there was going to be a gap in pensions that's approximately about 400 trillion by 2050. And just to put this in perspective, Kenya's economy for 2019 was about $100 billion. So when you talk about a pensions gap of 400 trillion, you can imagine what that means. And this problem was expected to continue to get worse because the funding gap was expected to grow faster than actually the economic growth globally. When you come back and look at Kenya's scenario, we were already in a situation where net replacement ratios for members had already been impacted, and we were seeing the average retiree who was leaving a retirement fund at the age of 55, leaving with an average net replacement ratio of 24%. And net replacement ratio is basically a conversion of your pre-retirement income compared with your post-retirement income. And so if you were earning about 100,000 shillings before retirement, it then means that in retirement, you're only earning a monthly income of about 24,000 Kenya shillings. So before coronavirus happened, already from a pensions perspective, there was a lot of pressure, not only globally, but also in Kenya. And, the situation was already dire. And if we look globally, and if we look at the last 4 decades, I thought it would be important to just look at what have financial crisis has there been, and what has the impact on retirement funds been in the last 4 decades. Now, any typical retirement fund has three main segments where money comes in through contributions. We have in the retirement fund investment income and expenses, and then we have benefit payouts at different points. When you look at the different financial crises over the last 3 decades, you look at the Black Monday of 1987, you look at the mortgage subprime crisis of 2008, and you look at 2011, where pension scheme returns in Kenya dropped by up to about 16%. Most of the impact was being felt in the retirement fund, and on a valuation basis, the money in the retirement fund was affected. But when we look at the situation in 2020 with coronavirus, it is no longer a health crisis, it is also now a social and an economic crisis. And as such, we are seeing pressure on contributions coming in, and that is where employers are having constraints with respect to revenues and are perhaps relooking at how much money they should be putting into pensions, if any. We're having depressed valuations evident in NSC and bonds, and you can already see that for Q1 alone, the NSC dipped by about 25%, and pension funds are basically sitting at about -7% for Q1 alone. And then in respect to benefits paid, we have a situation where a lot of employers perhaps might be seeking to exit members, and these members who might not necessarily have immediate term cash reserves might be looking to cash in their money from pensions. So the coronavirus situation for a retirement fund is a little bit unique because it's not only focusing or having an impact in terms of the retirement fund monies themselves, but also has an impact on monies coming in as well as money coming out. So when you look at now members, because we've talked about the retirement fund, I think it's fair to say that members have a lot that they're thinking of. First of all, everybody is wondering, will I contract the virus? And if you've already contracted it, will you contract it again? I don't know about you, but I've been walking around with a mask and I'm not even sure. You know, you have the blue one, you have the white one, you have the Ankara one. Recently, someone said you should wear two. You know, so at this rate, we're all just masking up and hoping that we make it. When you're looking at your earnings, we're all asking, how long will I have my job? How much will my pay be? Will my employer reduce my earnings? Will they choose to exit me? You know, because we live in an ecosystem, we're also worried about our family's health, particularly where you might have family members who are not covered by medical insurance, and you're asking, if someone in my family was to fall sick, can I afford an ICU bed? Can I afford the medical treatment that they need? We're also all worried about our mental health. And I said, I don't know about you, but everyone feels like I need to talk to someone. You know, I'm going crazy in the house. And you know, by now you have bonded with your house. You know, every corner you have done cleaning. A lot of you have even gone back to cooking gourmet meals. But I assure you, after 3 weeks, we are all just done and we want to go back to work. And on a social perspective, some of us are wondering, will I still be married after this? I don't know whether you guys have seen this, but in China, actually the divorce rate has gone up by 40%. And you've gone from spending 10 to 15 minutes with your partner to seeing them literally morning, mid-morning, later morning, you know, lunchtime, and it's just half day and it's just one day. And by the time you're done with one day, it's really been a long day. I like to tell members that this is actually truly a test of what retirement will be, because you're now at home. You don't necessarily have to go to work, and now you have all the time and the love and the affection to share with your other partner. So from a social perspective, we're still asking, will you still be married after coronavirus? And for those who are not married, perhaps the question is the prospects you had for dating before coronavirus, will they still be available, or will they perhaps have made an emotional connection through an online platform that you're not on, you know? So basically our members, our retirement fund members, are full of worry, and that worry is very holistic. It extends from health issues to financial issues, mental issues, and social issues. Some people are even worried about not going to church on an ongoing basis. So to put into context, coronavirus is a social economic crisis over and above it being a health crisis. And trustees need to recognize that the members that you're talking to are not your typical member right now. They actually have a lot on their mind. And as I said earlier, at this point, the interesting thing is that these questions are not only affecting one age or one spectrum. It doesn't matter whether you're in your 20s, your 40s, or your 70s. All members are actually very worried right now and perhaps asking key questions. So no matter what stage you are in, coronavirus has had an impact on your retirement fund journey. So if I move on very quickly to the advice portion of the presentation, I think the first thing to notice is that this is now a duration issue. Coronavirus is here and it is here to stay. And from our perspective, the longer the coronavirus situation continues, the higher the risk to financial security in retirement. The sooner we get back into operations, the sooner the economy can be opened and we can go back to work, the higher the chance that we can redeem ourselves in financial security in retirement. Generally, members have increasing pressure on disposable income, and we are trying to advise members to try and manage their expenses, or also look at innovative business ideas. When we initially had around March 13th, when coronavirus was announced, I'm sure we all saw long queues in supermarkets, people shopping to ensure that they had enough stock to outlast the coronavirus. But if you take fast forward 3 weeks in, supermarkets are actually closing. And that tells you that we've gone from a situation of spending immediate cash to manage a short-term crisis to a point where we don't have easily available money to spend on large amounts of shopping. So initially, while the likes of Carrefour and ETC were making billions, I think they reported 1.4 billion in less than a week, you now have a situation where people do not have disposable income to go and do that daily shopping. And that is a reflection of the increasing pressure on disposable income. For members who are in a defined contribution scheme versus defined benefits, I think it's fair to say that defined contribution scheme members are immediately more exposed than defined benefits. And this is because DC scheme members carry investment risk. They carry most of the risk. However, if the situation continues to be exacerbated, then there is existential risk for defined benefit schemes, and funding plans that employers might previously have put in place will come under pressure. We also have a situation where, as normal, when there is stress or loss, that risk appetites finally disappear and members take a flight to safety. So we are advising members that perhaps this is not the time to be safe. This is not the time to cash in your investments and go and put your deposit because you're going to crystallize the loss. Perhaps you should sit and wait it out. Again, overarching advice is this a time to continue saving? I got a call yesterday from a client who said, with this new tax relief, I find myself having a little bit extra cash and I want to put it into pensions. And I can tell you, I only received one call yesterday, which really tells you that everyone else is saying, thank God for the additional cash. Perhaps I need to stash it somewhere else. So the question for members is, where you have additional income, perhaps isn't it better for the long term to look at putting even half of that away into long-term savings, which could be your pension fund, and then maybe using the rest? For those members who have one-off service benefits, so for instance, if you're undergoing retrenchment or something of the sort, this is literally the only money you have. So the question again would be, should you continue saving? And our view is you should continue saving. The question will be, how much of it can you afford to put aside? And then last but not least, last week we had an RBA circular being released on suspension or variation of contribution rates. I think the circular, there's a lot of mixed feelings about it. I think employers feel that there is an environment of understanding their constraints, and so this is a positive move, allowing them to go through a process that allows them to suspend or reduce contributions. Members and market practitioners would tell you, in a situation such as this, keep saving, because at the end of the day, the pensions literally might be the only thing you have left at the end of the day. We feel that on an overall perspective, the market will be impacted with employers, as Kwame said, in certain sectors such as hospitality, and we are now seeing retail, non-food retail being impacted, that we will see a reduction of monies coming into pension schemes in the short term. And our advice to you as an employer is ensure you take legal advice in terms of what you're pursuing to do, because any change you make will have an impact on contracts. The next few slides basically focus the advice on age brackets, and I'll just go through this very quickly. If you're within your 20s to 30s, you have a longer earnings horizon, you have a longer investment horizon, you probably have flexible expenses, and we all know it's a large spend on data and entertainment. You probably have a lot of consumptive debt, a phone loan, a car loan, very good online gambling, and you have a lower immediate need for cash. You probably have just started saving, so the monies in the pension scheme are lower compared to the older members, and so the immediate impact on a 20 to 30-year-old would technically be lower. Our statistics show us that a 30-year-old saving 15% per annum will see a decrease in their net replacement ratio by 3.2% if they have a one-year interruption in saving. So our advice to 20 to 30-year-olds is continue to save and continue to buy in, because you have the time to ride out the storm, and you need to increase your savings by 0.7% next year, or make a one-off payment of 15% next year to ensure that you cover the one-year gap for interruption in saving. If I move to 40 to 50-year-olds, you are basically a high stakes accumulator. And by a high stakes accumulator, we mean that you're still in the savings stage or accumulation stage of your savings journey. However, you also have a lot of pressure in terms of your earnings. So you have medium to short earnings or investment horizons. You have higher and inflexible expenses such as a mortgage. You've got children's school fees. You probably have higher debt levels mixed between consumptive and constructive debt. And you probably have an immediate need for high amounts of cash today, that you need to pay out, rent, you need to pay out school fees. So your need is a lot. You have a large retirement portfolio, and so already coronavirus has had a larger valuation impact on your retirement fund. The average 40-year-old saving 15%
Angela, I think we may have lost you. Kwame, Nicholas, can you give me a thumbs up if you can hear her? Or a thumbs down if you can't?
We can.
You can't, yeah. Angela,
Yeah.
sorry, your internet, I think you...
Yeah, Bill, please ignore. Not
Angela, sorry, if you can pause for a sec.
She's back.
Hello?
Hi, sorry, we lost you for a bit. I think your connection dropped a little bit.
Okay.
But,
Am I
we can hear
back?
you
You
now.
can thumbs
Yeah,
up me.
yeah, yeah,
Okay,
you're
great.
back.
So let me just, I can start with the 40 to 50s slide. Okay.
I think we got through about half of it, but yeah, carry on wherever.
Okay, fantastic. So I'll just pick up from the end. So
Okay.
if you're 40s, in your 40s and 50s, you need to sit still and do nothing. Ignore your instincts for flight to safety and wait for a market recovery. If you are in a place where you're going to be exiting employment, and typically if you're in your 40s to 50s, you probably would be a good target for an early exit plan from your employer. Try not to cash in your pension. And probably you need to increase your savings next year by 0.9% to ensure that you catch up on the 1 year interruption. If you're in your mid 50s to 60s, you are basically on the edge because you have less than 5 years to retirement with a very short investment horizon. You have higher expenses such as a mortgage, but a lower need for high amounts of cash. Hopefully your children have finished school. And because you probably have the largest retirement portfolio, you've experienced the largest valuation impact because of coronavirus. Now, where we are, the question for you is, what was your last net replacement ratio assessment? We need to manage that. So don't panic. Again, ignore the instinct for flight to safety investment. Wait for a market recovery. Perhaps you need to think about deferring your retirement by 1 or 2 years so that you can increase your earnings horizon. And you can also plan to inject money from other sources into your retirement plan. If you're in your 70s, then you're a decumulator, so you're already in retirement. And in this period, our advice to you is reduce your expenditures where possible. If you're in an income drawdown plan, you need to reduce your drawdown amounts at this time. And if you're carrying an annuity, you need to consult your annuity provider to see if there will be any adjustments either in the guaranteed rate or the annual inflation that they will apply. Do not panic. Again, await for market recovery. You need to review your investment strategy when the market recovery happens, and you may need perhaps to take on some risk in the short term to gain positive returns for your portfolio to recover. And last but not least, please stay at home alone because of your health. In summary, I think our advice to you as Zamara is that smooth seas never made a skilled sailor. And we have basically been seeing a trend where every 10 years we undergo an event. And it would be prudent for investors to keep this in mind, that every decade we're probably going to go through a situation where we go through a financial crisis or a social economic crisis, because that appears to be the trend. It's not taking 40 years anymore. It seems to be happening every 10 years. The truth is that the markets will recover. They always have and they always will. It's just a matter of how long it will take and what will the new normal be. So members need to have that comfort that the markets will recover. We need to offer practical, holistic, and real advice to members. The truth is, you can't talk to someone about long-term needs if they don't have food for today. So in our advice to members, we need to be able to address their financial well-being that deals with the short-term and the medium-term needs in order for members to have a realistic plan for long-term. So don't come today and talk to me about 20 years if I'm worried about my job for the next 1 month. So advice needs to be holistic. It needs to be practical so that members can be assisted. We also need to know that members are vulnerable right now. Pensions is probably one of the easy pots of money that we have. And so we need to watch out for the type of advice we are getting, the type of platforms we are using to interact, because, you know, the conmen know that we are easy prey. And last but not least, we need to take advantage of the opportunity, because in every crisis, there's an opportunity. And members need to ask themselves, will you be the ones sitting under the table hiding, or will you be the ones like Saudi Arabia looking at your gold reserves and looking to buy out the rest of the world during a financial crisis? I think this is a time for us to work together, and I've come to the end of my presentation.
Thank you, Angela. Great stuff. I think there was a lot of interesting things in there. Okay, so maybe taking from Angela's last slide about riding out the investment conditions and waiting for recovery, being brave. It's about being brave. we did a poll that kind of relates to this. So maybe I'll ask the tech team to share the results of that poll so we can see what our attendees are thinking in this space. James and Art. Okay, here we go. I hope you can all see that. If you can't see the summary of the poll results, just post it on the chat. The question was, given the share prices of Kenyan shares have dropped, what would you do as an individual? 21% have said, I am a long-term investor, so I would keep my share portfolio unchanged. 70% said, buy more shares and take advantage of the low share prices. Only 3% said, sell to avoid any more losses from the drop in price of shares. And 7% said, I don't know. So Nick, you've seen 70% have responded, buy more shares. So the next time you're in a trustee meeting and you're getting whipped for performance, just remember 70% said they want you to buy more shares. Okay, so thank you for your responses to that. I think we can move on to the Q&A. And I think what we'll do is I will guide the presenters through the Q&A. I just wanted to mention there were a few questions regarding changes to the RBA Act and some of the initiatives that brought in with Corona, as well as tax rules, so the finance bill. I would like to just note a couple things. First of all, our webinar on Wednesday will cover both of these items. So please save your questions and we'll go through all that in more detail. But I did want to mention that for those of you who did see the initial draft of the finance bill, you would have noticed that it was extremely punitive to pension schemes and to our industry. It was basically an existential threat to pension schemes where the government wanted to remove the tax-free investment returns for pension schemes and also tax pensioners on collecting benefits. So we here at Zamara fought very, very hard, and we made some very strong submissions to the cabinet and to government. And I just wanted to give a little shout out to our CEO, Sandeep. I'm not sure if he's one of the attendees today, but he worked extremely hard, and I'm pleased to tell you that all of those punitive measures against schemes have been removed, and in the final bill, they're no longer there. So we were heard, and I think that's good to note. There was a question, Priska, you asked about taxation of pensioners over 65. The initial draft had that, but the final bill, it was removed, so we managed to succeed there. So that's some good news. Now for the Q&A. What I would suggest is, Nicholas, yeah, you a live answer, exactly. I just wanted to tell you. So let's start from the top. So Nick, tell us about the property market.
Okay. Thank you, Adil. And as guided, I'll just respond to the property market and then probably talk about this as we move on. There's a question from the property market from Edwin, which is, and the question is, will the long-term effect affect property market with the reduced rentals that you're seeing? Everyone is giving concessions, including landlords. So from our point of view, of course, that will have an issue in terms of the short term. But however, if you look at what I presented earlier, we expect to see probably an attempt to go back to normalcy at the end of Q2. And as we move into Q3 and Q4, then things will go back to normal. Now, based on what kind of tenant you have, the people will start slapping back the normal rates as we progress. But as we stand, and even as you look at the guidance from the Association of Valuers, even doing a valuation of a property right now is not really encouraged, because you'll actually be valuing using rents in an abnormal situation, and those values of the properties will be heavily impaired. So you'll see for the institutional investors like yourselves, pension schemes, you try and prolong those valuations and extend them as much as you can. When you go back to normal, then you can actually carry out a proper value. If you do a valuation right now for any property, you have what you call an inconclusive report, because it's based on the rental levels, and the numbers which you'll be spitting out will be significantly reduced. That said, Edwin, I think we're all going through a change of what we thought was normal, including the fact that what we used to spend our time on is not as important as things are panning out to be. So you'll see people change their way they invest. People move away from just land banking and sitting in large stacks of property. And probably that effect will also come through with a strained loss of economic time or economic activity by people losing their jobs or falling in and out of jobs or having to reduce what they receive at the end of the month. And you'll see properties will probably have a lagged effect before they take up. What you may see react a bit faster and this is straight to the poll you've seen there, which is things like share market, like shares and stocks, which people jump in fairly fast. That's my response. Adil, do I proceed to the others, or you call out as we move on?
Yeah, take the next one. I think we'll just go in order.
Okay.
Let's try and keep them short and snappy because it's 10 past 11. We promised to finish at 11, so I'd like to try and take, say, maybe 10 minutes to answer all the questions. Next one is you as well, Nick.
Okay. So from your screen, what is the next question? Is it the one about
offshore?
Quarter?
I think you answered
Offshore.
this in the chat.
Okay.
But you can maybe just, for posterity, just give a quick answer and move on. And then the next one is promised.
Okay, so I for all the questions I've gotten, I've put a live response on just for people to see. But quickly put them as offshore is one of those markets which is slightly higher risk as compared to equity markets, and you will see the reaction in equity markets normally follows what happens in offshore. So the depressed prices happen in offshore, then came through to our markets. Even the rebound as well will follow the same pattern, mainly because our market is about 70% reliant on foreigners. So offshore markets, in my opinion, will probably take off faster than equity markets. Is it the right time to go in? Again, for institutional investors, when you're holding money on behalf of third parties, sometimes there's a bit of balance that you need to maintain. But on an individual level, especially people can take higher risk. Definitely think you have very low valuations, which will probably jump up because of this thing is getting over, and then of course pick up as economic factors and economic activity picks up as we move on.
Thanks, Nick.
Adil, that's it. All right.
Kwame, the next question I think you are going to answer, and you've said you'll answer live. So this is holding all factors constant. By when do we expect the economy to start an upward growth, having fallen to the lowest of 1%?
Okay. Well, it's a bit difficult, I think, because the last figures that were released for the first quarter of this year had not completely taken into account the harshest effects, because most of the harsh effects of COVID actually and infections were in this month. So maybe the next quarter will tell us much. But I think one thing that I know that says we're not out of the woods yet is, irrespective of what government does at the end of the 21 days, I think there's a lot of businesses that have been in distress. I think some of them are closed, and they probably, unfortunately, some will not be coming back, which means obviously the employment and the difficulties will continue for a while. But I also think that if you look at because I tie this with another question about the revenues, if you look at government revenues and government, the care collections that were declared, about 600 billion behind targets, and that is expected to be collected within a quarter, it's clear they're not going to achieve that. What that might mean then is they'd probably be coming to market to try and borrow, try and get some money from elsewhere. What that does to the interest rates, I think we can guess. But on the whole, I think this quarter, just like everybody seems to be saying, the last quarter has been a significant contraction in the US, and we saw those employment numbers. I think this is probably the story for most major economies. So a recovery is not possible. I think, however, that one big thing would also depend on how Kenya handles, because this is the growing season and food, being able to have food, especially for subsistence farming for families, is one major shock absorber, because it allows people at least to be able to stay at home, have some incomes, and also stabilize lives. If this season goes badly, and that means we have another shock of food, in addition to locusts, and in addition to even if we have a weather shock and COVID put together, would mean that our second quarter could also as well be lost. The only thing I think is that it will be very slow, not negative, certainly not. So my expectation is that the next quarter will tell us much more than everything else, because obviously it will be a full quarter of managing COVID, and we'll be able to tell what happens. But government revenues certainly are well behind the targets, and I think there'd have to be significant revisions downwards.
Thanks, Kwame. The next question is for you too, the one about the United States economy compared to the Kenyan economy.
I don't know. Let me just say that as I see it now, and the good thing about the US economy is it's fairly open, so you can see and you hear a lot of business people say things and all that. It's going to be a tough one, to be honest, but the point is open economies tend to recover quicker. I mean, that's just empirically established. Why? Because open economies tend to have many more sectors. So even if you talk about 2008 and the shock in 2008, the recovery was led by other sectors outside land and property. So banks were able to, in a short while, of course, with the tap, were able to hold their own, and for that reason continue to do well, or at least recovered. So if you have a diverse economy, they tend to achieve. So I don't think it's something to do with anything more than actually that if you have a diverse economy and decision makers make the right things, then businesses respond in the best way they know how. And the good thing about the US is that, yes, if you're borrowing in your own cash and people are prepared to give you 30-year money for like 1 or 2%, then you have a lot of scope to do many, many things. That's not what our options are here. And so it's going to be tighter. But I think the biggest concern for me is that maybe because government doesn't have the cash, and that's possible, but there's just no thinking about how do we make it easier for farms that are struggling, that actually just need to stay afloat so that when the recovery opens, it'll be. So my fear is that we're going to have an L shape. You've all had it, right? An L shape, a U shape, with the U extended for quite a long time. And that, in my view, was not necessary. Given whatever it is, we could have had a much, much shorter one. So it's going to take a little bit longer because, yes, it's true. Businesses are going to close. So obviously, again, it's going to affect property because rents, either people are going to shrink their own business premises or actually close in and seek other things. So that ripple effect and the adverse side is going to be much, much more, because government seems to be dealing with, let's maintain the food situation, providing some limited support to people, and that's entirely good. But a lifeline for businesses, in my view, was imperative. And it was affordable because it's something that can be done. It would have paid for itself very, very quickly.
Thanks, Kwame. Looks like there's a few questions for you in a row. So the next one is from Maurice about assuming if the pandemic continues for a year, how will the Kenyan economy survive and what tools do decision makers have?
Okay. Let's just start with what we think we've gone to so far. So when this pandemic first came in, and when we had we had our first patient, I think, identified on 12th or 13th of March, everybody panicked because the forecasts by the modelers was that we would have, by mid-April, 10,000 people afflicted. As we are now, it's like, I think about just, how many? 4% of that, which makes us 4% or 5% of that. So obviously something's working for us, whether it's by design or by default, and that's something that we all welcome. So I think the shocks on the whole, on that side would probably be, well, we shouldn't touch wood, we shouldn't say we are out of it yet, I think. But on the whole, it's far, far better on the health side than we are. Of course, some 15 lives have been lost, and that's obviously regrettable. But many people thought that by now, obviously, systems would be overwhelmed and we'd be having a crisis. So the crisis is still here, but we haven't had a surge in infections, and I think that's a good thing. Now, what does that mean? For that reason, what it shows that this situation can still be brought under control. But what worries me is, government mentioned yesterday that the testing capacity is about 37,500 per day. We are testing 500. The problem about testing 500 is it doesn't give us a good indicator of how pervasive the infections are. Because if we knew how pervasive the infections are, and we know that the hotspots are specific places, then businesses could be told, look guys, you can reopen. But right now we have to be tentative because we don't actually have a real indication of how pervasive the infections are. And we know that these things can roll very, very quickly in bad ways that could harm us. So people are going to continue to be like this. And what I fear is that it's going to give us on a trajectory of feats of stop, start and stop, whistle, stop, whistle. So that's the part that worries me. But on the whole, I think there will not be a contraction in Kenya. That's my thinking. Growth rates will definitely fall, and government response, notwithstanding how weak it is helped significantly by the fact that this thing has not been as pervasive as was anticipated. And as more thinking is going around here, I would think. Now, let me mention something because there are businessmen on your call as I close. I saw yesterday newspaper reports showing that businessmen are actually bringing in significant sums of money into the COVID fund. If I was them, that's not what I'd do. for two reasons, the transparency questions aside. But my view is that what I do is I actually ask business people to lay aside their own fund and provide a challenge for scientists, whether in Kenya or elsewhere, to construct a test, right, that could allow us to turn around testing at scale and pay somebody to actually design such a test. And I'm sure laboratories in universities and in Kenya could actually do that. So you have a rapid test that can be done that gives you the results in 4 hours or so. And if you can do those tests and scale the tests as well, because they'll be cheaper, then obviously the money goes further and everybody can test their employees. And as soon as we all find, like there are 25 of us in the office, we don't allow more than 5 of us in the office at any one time. And that's possible for our kind of business. And I think for some of you as well, but it raises some inefficiencies. But if we could test very, very quickly, we could all test our employees and tell people, guys, now that you've tested, we provide the masks and everything else, come to work. So outside that testing, I think we are restraining the economy much, much more. So if as a business person and you're interested in helping, you have a couple of dollars to put in for the public thing, it can actually serve the economy well if we simply roll out mass testing that's cheap and whose results and turnaround are quicker. Thanks.
Thanks, Kwame. Yeah, I think I was hearing about some mass testing and much more affordable testing that's almost ready in Senegal. So hopefully things like that will spread quickly. I think we've never been in a situation like this where the entire globe is so focused and together in terms of looking for a solution or a cure. So, you know, who knows? I think we might surprise ourselves with how quickly we can do things. There's a question from Jesse to you, Kwame. Maybe just a very quick answer. I think it's a pretty short question, so maybe just a quick answer to that. And then Valerie's question, Angela, if you don't mind having a look and answering that after Kwame. Thanks.
Okay.
Well, the question from Jesse?
Yeah, the one about government borrowing and
yes,
the effect on T-bills and bonds.
Oh yes, I mean, as I said in my last question is, yes, if government has to borrow much, much more now, what I fear the most about is what might be the tipping point. I know many countries elsewhere are now all that are printing money or trying to borrow. I think government is going to have to borrow. We haven't completed negotiations with IMF and everybody else, so it's still tentative. But government is definitely going to have to borrow in Kenya shillings, and that's going to extend the. I mean, what it's going to do is interest rates are going to have to rise for people like you to give them some money. But more importantly, because government is already in some kind of, I won't say distress, but in some kind of pressure to pay. So yes, I expect that interest rates will go up, especially the short-term ones. Yeah. Okay.
So just to add to that, Jesse, in terms of your question, if interest rates go up, that will hurt our existing bonds. But yes, you can earn higher returns on new bonds and new treasury bills. But it's painful for the ones we already hold. I think the other risk with that is inflation climbing up as borrowing increases, and then that will also reduce real value of whatever investments we have. So that those are not necessarily positives. Angela, Valerie's question about purchases of houses.
Okay.
Thanks.
Great. I'll give a quick answer. So I think at the moment, the jury is still out on what the net effect will be of this particular change in legislation. I know that for retirement funds, the biggest concern, number one, is liquidity, because then if you have members drawing out cash, particularly while in service, then you have to liquidate. You also have an issue around strategies. For instance, those funds that already have real estate, like our umbrella fund, is there an opportunity to do an in-kind type of strategy where members can convert their holding without you having to liquidate your investment instruments? I do believe, however, as Angela, that the property market was due for a correction, and that without this change, we probably would have seen some level of a drop in property prices. And this particular change has then delayed that effect, because then real estate developers then have a ready market who already have accumulated capital. And as such, that correction might not come. So what I can tell you for sure is the correction is not going to come now. It will probably be delayed. And we are hoping that some additional guidelines will be introduced with respect to this change, because then what happens to members who meet with unscrupulous sellers of real estate? What happens with due diligence processes? Because when you buy through a bank, at least you have that support. So there's some more work for the industry to do, but I think the jury is still out on what the total net effect will be on the entire economy, but it will be a positive for the real estate market, particularly the residential section of the market.
Thanks, Angie. There's a question from the anonymous attendee, and then David's question, which you were going to answer. So maybe you can just take them, because it's nice to hear your voice after so long. We've had the men. And then we'll
All
come
right,
back
so
to
okay, so there's a question here about the government slowly eroding the pension sector, still going back to this issue of allowing members to buy houses. I think maybe here I would like to create some context. Currently, the retirement benefit sector has 1.3 trillion in assets, which accounts to about 15% of the GDP. And as such, if you are in government, you would definitely, in a situation where you have perhaps some immediate capital constraints, be looking at this 1.3 trillion and trying to see what are the ways in which that 1.3 trillion can be activated, particularly for the market. So in my view, I think that the government intention is to tap a very important sector to support government initiatives. And I think that at the end of the day, the work remains with bodies such as the Association of Retirement Benefit Schemes, the regulator RBA, and investment teams like the Kenya Pension Funds Investment Consortium, trustees coming together to see how they can lobby government when these changes are being made to ensure that the voice of pension funds or the interests of pension funds can be upheld. So it is not unusual to see a government putting in measures that will release money from pensions into another sector. Adil talked about taxation. Again, it's not unusual to try and see tax trying to be introduced so that the government can get more money. I think the work is how can we ensure that we protect the industry, and how can we work together to lobby to ensure that when these changes are implemented, they are towards the best interest of members and towards the best interest of the industry.
Thank you, Angela. I think the next one as well about the hospitality industry from David. Maybe you can take
Okay.
that.
Yeah, I'll do a quick one on that one.
Okay.
So, David, thank you for your question. The RBA last week introduced a circular guidance, and it basically talks about what happens if you're not paying salaries, what happens if you're suspending, and basically in your situation where staff are on unpaid leave and there's zero salaries, then there is no action for you to take. What you need to do is advise the trustees and the regulator that, look, there is no money to be expected because we're not paying any salaries, right? However, we have seen a lot of clients in the hospitality industry then saying that they do have some level of partial salaries, and for that, they would like an exemption from the regulator for suspensions. So currently, variation of contribution rates is provided for within the trust deed, but suspension is strictly not provided for in the trust deed. So an employer who wants to do that then needs to do an application to the Retirement Benefits Authority, and provided the members have consented, the regulator has indicated that they have no undue concern on that. So direct answer, David, for you, no immediate action, just notification. But in the event that you're paying money and you want to suspend pension, then you need to go through an application process, and very importantly, ensure you undergo a mechanism of member consent, because it does touch on contractual terms of an employee.
Thank you, Angela. Kwame, there was a question from Gladys. It was at 10:54. I think you've already answered it, but let me ask you if you think you have. Do you think the government is doing enough to mitigate the effects of COVID-19, or what more can be done to ease the economic effects? I feel like you've kind of answered it, but I'll leave it to you to decide if you have something to add.
I think my view is that it's clear that many businesses are raring to go. I mean, people want to really open, but they're looking up to the government for that advice. So for as long as our tests are so low at 500, you really cannot tell how far or how pervasive the infections are. And that's what business people fear. Nobody wants their staff to die or to infect others and create problems. So my view is that if there's one area in which some effort could be done, obviously it's in ramping up those the tests, so that people have a clear view about whether what people call the lockdown or the curfew is working. And if it's working, how far do we have to bring back the infections before it's safe for everybody to the infection rate before it's safe for everybody to open, because people want to open. I mean, nobody likes to close down businesses earlier to inconvenience their clients and everything else. So that's an area in which government should do much more. And I think if they concentrated on ramping up that quickly, make it quick, then obviously it should it would help a lot. Yeah.
Thank you, Kwame. Nicholas, there's a couple questions I think you can answer. The one from Pauline about, is this era of COVID-19 predicted to cause a market recession to every part of the world? China seems to have recovered, the other parts are struggling. Maybe you have a few comments on that. And then the next question below that about a new way of working from home and the potential impact on office space demand and property market. If you can just wrap up with those two questions.
Okay. Thank you, Adil, and thank you, Pauline, for that question. I think this is the era of COVID-19 pandemic predicted to cause a market recession. The true answer to that is it most probably will, because of the lag effect that you expect to see in terms of the economic numbers. Economic data, I think for the first time we saw in US, the economic data for Q1 is way below even 2008. But that said, there are still different stages of recession, and also why you're seeing so much stimulus coming in is to minimize that impact. So there will be a new resetting in terms of where people operate and where trade comes from. In particular, I think China people are really pole vaulting in terms of getting their stuff produced from China, but that will take a while. It's not a one-quarter thing. It's probably will take another 3 years before people are able to shift away from relying on China. So there will be some new reformatting of the world, but that said, I think the governments are doing their best just to avoid, just like in 2008, where we had a number of stimuluses come in and we were able to help most companies and most markets to go through. I think we'll have the same thing in 2020. Okay, next question, Dil was?
Yeah. Regarding the office space. So considering that working from home might become a new norm, what effect might that be in terms of office space demand, and will it affect the property market in the long run? Interesting question.
Yeah, excellent. In fact, it's interesting because I was actually going through that discussion in my head when I was driving here, I think 2 weeks ago. And I looked at the new numbers of buildings, which are, even before this pandemic, were actually empty. So we, like in Upper Hill, if you look at the report from Knight Frank for year 2020, the supply of office space was excessive, was above the market demand. So for sure, we expect to see a change in terms of demand for office space. There are companies already who are debating why am I been holding 2,000 square feet of floor when I can actually operate on just half of the amount. So we expect to see a bit of that formatting. One of the first effects you see is a dip on the rates, but for commercial buildings, you see most people are in 5-year contracts, which means it's a bit difficult to unwind from it. But progressively, as you move on, and bearing in mind there are buildings coming up, you'll, for example, see them bill at probably much, or ask for much lower per square foot as compared to what they've asked for probably a year ago. So there's a long run effect which will come to place. But at the backdrop or the back of my head, I'm very much aware about the demographics of Kenya. We are still sitting with probably about 60% of the population at a very young age. We're talking about 55% below 20 years. When that continues coming to the market, then we expect to see probably a pickup in terms of either supply of offices or also a build up in terms of the rates that people can ask for. But in the short and medium term, you'll see a few adjustments on the office space. Thank you.
Thanks, Nick. There was a question which just disappeared. Okay.
Sorry, Adil, I answered it.
Oh, okay. Yeah, I was going to ask you to answer it, but
okay.
So I think attendees, that pretty much brings us towards the end of today's webinar. Thank you so much. This was our first one, and I hope you enjoyed it. I think on the chat we had mentioned something about the Zamara member portal. In case you did not see it on the chat, I thought I would just mention it. So we have a member portal that's accessible through the internet, and it's a great way for your members to access information on their pension scheme. For example, their balance, contributions that have been made, etc. This can all be done online so that they don't have to physically come into the office. The IT team will post the link again. IT team, I hope you're listening. Please post the link again on the chat because I know it's It's much further up on the chat and it will be difficult to find. That portal, there you go. It's https member.zamara.co.ke/member. So you can share that with your members. As I mentioned, this will be a series of webinars that we're doing. This is just the first of what we hope is many webinars. I'm really thrilled to see how well this one was attended, and I hope to see you all at the future ones. The next one will be on Wednesday in the coming week. So we hope to see you then. Happy Friday, everyone. Tomorrow is a public holiday, so that makes this evening Friday. Drink at home. Be safe. Physically distance, but don't socially distance. Call your friends, make sure they're okay. And thank you all for attending. See you all.